Ladies and gentlemen, Jeff Snider, the head of global research for Alhambra Partners, and I have been doing, my name is Emil Kalinowski, by the way, we have been doing this show, Making Sense, a Eurodollar University production, almost for a year. And in that time, two questions have come up most frequently. Number one, what are bank reserves? What can they be used for? And number two, only came up recently in the last 2 weeks. And that question is, what happened in the repo market? Why are rates negative in the repo market? What's happening to the treasuries used as collateral? That came up about 2 weeks ago. Jeff and I did not talk about it last week. Wow. Emil, are you going to talk about this? Are you guys talking about this? What are you guys doing? When is this going to come up? Here's a tweet I received. This one I saved. I don't know who you are. I don't know what you want. If you're looking for ransom, I can tell you I don't have money. But what I do have are a very particular set of skills. Skills I have acquired over a very long career. Skills that make me a nightmare for people like you. If you talk about the repo disorder, that will be the end of it. I will not look for you. I will not pursue you. But if you don't, I will look for you. I will find you. It goes on from there. Jeff, please, for my safety and for the edification of the audience, what happened? Where shall we start with the repo market, the disorder, its specialness? Where do we begin?
Well, first of all, I don't think it's our policy that we negotiate with reader terrorists who threaten your life and your well-being. So we should probably just give right into them. Well, there's no negotiation here. We'll give the people what they want, right? Let's talk about repo. Let's start with what is actually going on in the repo market. And really, it's something called specialness, which isn't all that abnormal. Repo, it's not like there's a single market. It's not like a single security trades all the time. All sorts of CUSIPs, all sorts of individual security are traded. They're borrowed, they're lent, there are all sorts of things going on. And at times, certain securities become more valuable or more in demand than others. And when we see that happen, that security becomes special and it creates something called specialness. When we look at something called the repo rate, the general collateral repo rate, for example, that applies, as it says, to general collateral. And if a repo security, a particular US Treasury instrument or MBS instrument too, becomes special, it's going to trade differently than the general collateral rate. Usually the rate on the repo that goes special will go below the general collateral rate. And that's how we know it's special. That denotes to us its specialness. So that happens all the time. There's always repo securities trading special, but they don't always get to be so special that even the mainstream media talks about repo again, which apparently the media never likes to talk about repo. And maybe this is why, because it seems like it's a really complicated, tangled mess. But by and large, what we're seeing is that there are, especially the 10-year CUSIPs around the 10-year maturity, over the last couple of weeks, they had traded so ridiculously special that it became something of a news event.
So CUSIP, for those that don't know, is the identification number of a particular treasury security or stock or some financial instrument. So we're talking about a specific stock, a non-fungible. I guess that's non-fungible tokens are in the mainstream right now. So it's a specific security. And we don't see this in the general collateral markets because you can replace one 10-year with another 10-year treasury security. Is that right? So
yeah, and remember, there is no tenure. There is no bond that is exactly 10 years in maturity. Even the auction bond, like right now, there was an auction conducted this week, which was a 10-year reopening. And what that says is that it was actually sold off as a 9-year and 10-month maturity. So, I mean, there is no exact tenure. There's a bunch of different CUSIPs that trade close to that 10-year maturity. And don't forget, there's also, say, 20-year bonds that were sold 10 years ago that still have 10 years to maturity. So they kind of get thrown in the mix, too, because they have 10 years left. So there's a whole bunch of securities that are sort of like 10 years. And so which ones are trading special, which ones are not trading special, that's really kind of the issue, is that when they do trade special, what that tells us is there's additional demand for them.
Okay, ladies and gentlemen, so we sort of set the stage, and now we're going to go back and give a couple of reasons. That's what you do, Jeff. You give a couple of reasons why this might be the case. And the article that we're going to be referencing for everyone so they can read along is Deja Vu, Treasury Shorts Meet Treasury Shortages, posted March 9th at Alhambra Partners. And you begin, Jeff, by telling us that one of the reasons why this might be happening is because investors might be short bonds. Can you tell us the story of why they might be short bonds? And then the very interesting dynamic of not buying back when you're short. Maybe I'm skipping too far ahead, but that's the part I really want to get to is how you borrow more to give back what you originally borrowed. But why are investors short bonds?
Yeah, it's the same thing as shorting stocks, right? You're betting on the price to go down. So if you sell something today, you're hoping that you can buy it back in the future at a much lower price, profiting the difference. And it's no different. Speculators operate, speculators are going to short betting on the price declines in any market they can possibly find, including the US Treasury market. And so if you believe that the 10-year US Treasury, for example, is primed for a fall in price, which would be rising yields, you might short that section of the curve and heavily short it. And that's indeed what, again, it's a regular part of the marketplace. There's always speculative shorts in any marketplace that are looking to profit, either short-term or longer-term, intermediate term on price movements that they can take advantage of. And when you're shorting a treasury bond, just like shorting a stock, you have to borrow the security in order to sell it and then at later time cover that short sale.
That's right. Instead of buying first and later selling high, you reverse the process. You sell high and then buy back later. But you don't own it. So how can you sell it? You borrow it. And as a speculator or investor, you have to borrow it from someone. What repositories have bushels of these treasury securities? And do they remain calm? Are they saying, oh yeah, sure, you can borrow these treasury securities? Or do they sometimes get a little antsy and want them back?
Well, no, it's who has the treasuries? Well, the biggest source of treasuries in the world is the Federal Reserve. There's some a portfolio, but that's no good because that's just locked up in bureaucratic mess. Yes, they have a reverse repo, but you're not going to get treasuries from the Fed. So then you can only go to pension funds, insurance companies, institutions that have large static portfolios of securities because they have to. But you can't go to a pension fund and say, hey, I want to borrow your treasury. You have to work through a dealer. So the dealer is the one who has a securities lending business that's set up for decades and has been transacting with pension funds and insurance companies and other foreign, what they call silos that have available securities that can be lent out. So through the securities lending business of bank dealers, that's where you go to get your short, where you get to borrow the treasury security you don't own to sell into the marketplace to try to profit on a declining price.
And so sometimes these specific treasury securities or mortgage-backed securities, they trade below a floor. And people that don't follow the market very closely may not know what the floor happens to be at any one moment. But one intuitive floor is zero, you would think, like oil. It shouldn't go below zero. Or interest rates. And yet sometimes we do see a special treasury security trading special below zero. And what does that mean? It means someone is paying someone else to pay them
borrow.
Cash?
Yeah. You want to borrow my cash, I'm going to pay you to borrow my cash. Which sounds ridiculous. It sounds absurd, but it's indicative of the high degree of demand for a specific security. Now, I want to back up just one step before we get to that. When you're shorting any securities like this, including treasuries, you have an obligation sometimes to replace the security you've borrowed with the exact same security you've borrowed. Now, in general repo, it's not always that way. Usually, if you borrow a security to go into the repo market through securities lending, you don't have to give back the same security you borrowed. You can give back one that's kind of near the same characteristic or mirrors the same characteristics as the one you borrowed. But there are occasions when you go to cover your what you've borrowed, you have to redeliver the exact same security that you initially started with. So that creates an incentive, or it creates a sort of a bottleneck if you're not the only one who is short a particular security, and you're not the only one who has an obligation to redeliver that security, which is now where we're getting into why these particular securities, the particular QSIPs, trade so much special in these occasions, when everybody is short the same security and has the obligation to redeliver the same security in order to close out their trade.
I'm going to read an article or a little quick comment here from Bloomberg, but it's not about the repo disorder that just happened and repo rates trading special recently. This is back from 2013. And now we're going to diverge. We're going to show what the second reason why this might be happening. Because in the mainstream, the main reason is, well, reflation. You're selling short because things are getting better. Treasury securities should be falling. But there might be another reason, and we're going to pull up a graph from 2013. Okay, this is from Bloomberg, summer of 2013. Quote, Treasury notes with maturities ranging from 2 to 7 years have become coveted in the short-term market for borrowing and lending securities as the government auctions more of the securities this week. Traders have been willing to pay to borrow the debt in exchange for loaning cash for the most actively traded 5, 7, and 10-year notes, with repurchase agreement rates negative. Many times traders short or sell securities they've borrowed in the repo market ahead of a treasury sale to profit if prices of the securities fall after auction. Okay. Let me pull up the chart, Jeff, and then you tell us why the timing's off.
Well, like I said before, I mean, the trading special is not something that never happens. It happens, and it happens particularly around certain periods in history. 2013 was another one, and it makes sense why that we would have a lot of shorts in the summer, the taper tantrum summer of 2013, when interest rates were rising, meaning Treasury bond prices were falling. Of course, that's going to attract a lot of interest from speculative shorts who were absolutely short that market in the summer of 2013. But was that the only thing going on? And that's really what we're trying to get at here. Is shorting treasuries, betting on their price falling, the only reason why we would have such a high demand for collateral that it becomes so special it sticks out into the mainstream media? And if you actually look at what happened in 2013, what you'll see is that this outbreak of specials, a cluster of specials, if you want to call it that, actually started much, much earlier in the year, going back to even February 2013, so that by March 15th, I think we talked about this before, Emil, the Treasury Department actually issued a large position report request, which said, hey, if you're a big bank, you're a primary dealer, you need to tell us if you're accumulating a large position, and especially the 10-year Treasury, because we're seeing problems show up in repo market and repo specialness, because as early as February and March of 2013, a lot of specials, a lot of negative repo rate, negative special repo rates were starting to cause some angst and anxiety, not just in the marketplace, but among even central bankers and treasury officials. But I'm sure, as you can see in the chart here, if we're having repo specialness happen as early as February, March 2013, what was that reason? Was that because of people? Was it because of speculators betting on price declines? That's not really likely, because at that time there wasn't a whole lot of inflation. There certainly wasn't a taper tantrum. That didn't come until May, and there wasn't much of a sell-off anyway, because as you can see, interest rates were falling during those couple months, which meant treasury prices were rising. So if speculators were shorting, they weren't shorting a lot, and they weren't making very good bets.
Exactly. So. And then, but later it made sense, right? In this graph, after June, then we can say, okay.
Shorts make sense in the second half, but not the first half. And so we have to ask what was going on in the first half of the chart that may not have been, may not have ended in changed over to another thing in the second half. And the clue is what you see, what I have circled here in Treasury bill yields. So now you have Treasury bill yields falling, which means increased demand for bills. And why would that be? Of course, anybody who's watched the show or read anything about Treasury collateral and repo knows it's the same collateral shortage, especially when we think about what was the Federal Reserve doing during this particular period, the first half of 2013. The Federal Reserve had just implemented QE4 at the end of December 2012. Yes, there were 4 QEs up to that point, and QE4 was focused entirely on buying US Treasuries, whereas QE3 a couple months earlier had bought MBS securities or manipulated the MBS market. And not only that, when the Federal Reserve was conducted QE4 in early 2013, they were buying on-the-run bills and notes and bonds too. So they were in the on-the-run market where much of this, it's the most pristine, best quality collateral there is the on-the-run securities. So the Fed was taking up on-the-run securities before any of the shorts showed up, before any of that stuff later in the summer. And so was the Fed intruding itself, removing collateral from the system that created a shortage situation. Now, they stopped buying on-the-run securities around, I believe it was May, around the time we saw the taper tantrum. They stopped buying on-the-run securities, but that doesn't mean this collateral shortage ended and the shorts took over. And so what we're looking at by that chart is that before the shorts ever got involved in creating specialness in repo, indicating huge demand for high demand for collateral, there was the underlying collateral shortage the entire time, which suggests that when repos went special in the summertime, the shorts were only they're serving to highlight the overall collateral environment, which was not very good.
Buying on the run Treasury securities is monetary malpractice, and they should have been in front of Congress to answer for this crime. But 2013,
well, they were.
Or somebody should have asked.
Well, no, somebody did. In fact, his personal story here, at that time, I worked with, I won't say, but a couple of people in Congress who were supposed to bring Ben Bernanke in to testify in front of the House, but eventually they arranged for a private meeting. And they actually asked for my input about what to ask because of all this repo stuff going on. And, this was, I believe, June or July of 2013. And I told him, look, actually it was before that because it was the on-the-run issue was still going on. But anyway, I told them, look, they're buying on-the-run stuff. The market needs the on-the-run. The Fed's just stripping collateral from the system. Didn't hear back after this private meeting took place. And what I heard from one of the congressman's chief of staff was, yes, they had the meeting. They started to question Mr. Bernanke, who just ran circles around them because they didn't understand what they were talking about. And even though Ben Bernanke probably doesn't understand enough of the repo market to obviously not screw it up, he knows more than they did. And probably, I believe, as economists and central bankers always do, reverts into his mathematics rather than his economics, which simply serves to shut down all debate. So yes, at the time in 2013, there was official interest, and I can attest to that personally, over what the hell's going on in repo. And the problem is, as it always is, politicians are not equipped to even understand what's going on enough so that they can formulate formulate the right questions and get the right answers.
Thank you for sharing that with us, Jeff. Absolutely fascinating. I would have loved to have been a fly on that wall. Okay, so 2013, there's a mix. There's the collateral shortage, bad, disorder. And there's also the reflation, so it makes sense, shorting. There was no conflating the two in 2020, the last time we saw a repo specialness outbreak. Clearly, it was a shortage, it was disorder, deflation, and we knew that was what was happening. And now we're in 2021, and I suppose it's a mix of the two then, back to what we saw in 2013.
Yeah, we've got the bill yields falling previous to this outbreak of shorting, although there was a large short position in the futures market going back to 2019, so that's always been there. But really, we haven't seen the special issue crop up until, as you pointed out, just recently, which again proposes, okay, yes, there are definitely shorts in the marketplace. Interest rates are rising, Treasury bond, especially longer note prices are falling. So we know that shorts are out there. They're out there heavily shorting the marketplace. So that would definitely create some of the specialness there. But like 2013, aren't we also seeing the underlying overall structural shortage issue that we see in bills because bill prices have skyrocketed at the same time note and bond prices have fallen? So to me, it looks a lot like summer 2013 again, where we have yes, it's reflation and shorting treasuries and speculation and those kinds of things, but underlying it is the same structural problems that we've seen all along.
Jeff, I see here your final sentence in this article may be referencing what we just talked about, your experience in 2013. U.S. central bankers, however, don't even want to talk about it on the very suspiciously few occasions asked. That, too, remains unchanged from 2013. And you hyperlink to another article, which you've caught me. I didn't click on. Forgive me. What kind of a host am I? A bad one. Is that what you linked to, that story you just told us?
No, that was actually Jay Powell's recent testimony from Humphrey Hawkins, where he was asked about Treasury bill prices and collateral shortage. I won't say much more than that other than to refer to the previous story.
Okay, wonderful. Well, Jeff, is there anything we didn't cover on this very important topic?
Yeah, I think that what I would say in summation is, yes, the shorts are one of the primary reasons we're seeing the specialness in repo, but the reason we're seeing it is because these shorts, a normal functioning marketplace where we don't have a collateral shortage underlying everything, we wouldn't notice shorts, even when they're heavily involved in shorting securities, because a normally functioning market would have easily absorbed any kind of imbalances like that. This is a natural economic imbalance. It's not some major thing, or at least it shouldn't be. And the only reason it becomes major, and the only reason why the shorts and the specialness becomes a major news item is because we have this underlying collateral shortage that I believe has actually gotten worse over the last couple of months.
Let's move on to part 2 of this episode, where we're going to talk about M2 money supply absolutely taking off vertically. Might that mean that inflation is on its way?